Welcome to Bloomberg Markets. I'm Scarlett Fu. We're watching tech roar back as we await the Fed decision and earnings from Meta this afternoon. So here's how markets are trading in the lead up to those big events. You have the S&P 500 gaining 1.6% right now. Stocks rebounding, led by chip makers and big tech. And you can see the Nasdaq 100 gaining 2.8%. And right now, this looks like it's the biggest advance in about 5 months since late February. We are seeing buying in treasuries across the curve, and that is pushing yields lower. The 10-year down about 3 basis points at 4.10%. And notably, weaker dollar today, the yen getting a big lift after the Bank of Japan raised interest rates for a second time this cycle, and it announced plans to trim its bond purchases. All right, let's move on here to some notable equity movers at midday. NVIDIA is the best performer in the Nasdaq 100, pulling big tech and the broader market higher after Morgan Stanley named it the top chip stock, saying the recent sell-off has created a good entry point for investors. Let's also take a look at Starbucks, up after the company reaffirmed its full-year guidance. Now, its quarterly earnings were in line with estimates, and the number of transactions are falling, but it looks like U.S. consumers are spending more at each visit, and that helped prop up revenue. The stock up 5.3% over the course of 2 days. And MasterCard gaining after it saw global purchase volume jump 7% over last year. The company is also seeing growth in its global credit card count as consumers accumulate more debt. All right, as we mentioned, today is Fed Day, so that is a focus, obviously, for everyone as the Fed announcement comes out in just under 2 hours' time. Let's go now to Michael McKee, Bloomberg's Chief International Economics and Policy Correspondent in Washington, getting ready to head over to the Federal Reserve Building. Mike, the headline here is no rate cut is expected, but it's a matter of how much Jay Powell, the Fed chair, is going to signal that something is coming in September.
That's exactly right, and it's getting harder for him not to make that kind of signal, especially with the data we got today. The employment cost index is the Fed's favorite measure of wage pressures in the economy, and it comes in lower than anticipated at 0.9% overall. Wages and salaries just up 4.2%. That is a 3-year low. ADP payrolls came in very low, 122,000. By comparison, you can see the forecast for the non-farm payrolls on Friday for private payrolls is 141,000. So we're seeing weakening in the labor markets. We're seeing weakening in inflation. And then the Fed also has a big risk factor coming up Friday with that non-farm payrolls report. If unemployment goes up just a tenth, we trigger the SOM rule, which, of course, posits that once unemployment gets high enough, it starts to go higher faster. And that would be a real market risk. So the Fed has a lot to think about. And even though they're talking about they weren't talking about cutting rates today, there is a non-zero chance that they could. What you want to look for is changes in the statement, because there's no SEP today and there's no dot plot. They've got to change the way they talk about inflation. They have to change the way they talk about unemployment, and they have to change their forward guidance about waiting until they get to 2% target, or at least convinced that it's going to be there, because right now that looks like it's out of date.
Right. There's a lot to balance there in that announcement and, of course, in the press conference. How much consensus is there around the decision, this idea that they can afford to wait until September to do something? Bill Dudley, the former New York Fed official, president, called for a rate cut in July. Others have talked about the need for a 50 basis point cut when a rate cut does happen.
There are a lot more well-known economists who are suggesting the Fed is starting to get behind the curve. Jim Bullard, the former Fed Bank president of St. Louis, said as much on Bloomberg Television this morning. But the Fed went into its quiet period without saying that it was considering rate cuts in July. And so the feeling is they don't want to surprise the markets. Claudia Sahm, the mother, we'll call her, of the SOM rule, said today that the Fed may be putting more emphasis on its communications policy than on its monetary policy. We'll see how Jay Powell addresses that today.
All right. Michael McKee, thank you so much. Of course, Michael McKee in Washington. He will be breaking down the Fed decision when it comes at 2 p.m. And of course, Jay Powell will also take the lectern at 2:30 p.m. Let's continue this conversation on Fed Day and bring in Kim Friedricks. She is Managing Director of Fixed Income at KAR. For a little bit more here, Kim, are you comfortable with what the market is pricing in terms of a rate cut in September? And some are talking about 2 cuts for 2024?
I think that seems very reasonable at this point. The way I look at it, the Feds kind of set themselves up in a perfect situation. They signal everything today. They tell the world, we're getting ready to go. They've got their entire retreat in Jackson Hole to give speeches and talk about what they plan to do. And then in September, they can come out and actually get started. They can make one move in September, another in November, and then sort of wait to see how the entire election plays out, see how, the third quarter numbers roll in, see what's actually happening with the economy before they start making decisions about what they're going to do December and into 25.
Yeah, and as Mike reminded us, there is no statement of economic projections this time around. That comes in September. But Jay Powell has said even when they do give those out, they don't necessarily provide a lot of forecasting value because it's kind of a snapshot of a moment in time. What do you think might be in their thinking when it comes to the rate trajectory in 2025?
I think it's going to depend a lot. We'll see a lot of information come out in their retreat. There's a lot of economic papers that come out there that show you really a lot of what, their staff is thinking and what the information they're getting is looking at. But going into 25, we're going to have to see who's president? What are they shooting for their first 100 days? What does the makeup of Congress and the Senate look like? How much volatility are we going to see? If we're going to see, a gridlocked Congress and not a lot of action in the first 100 days, well, then, they might be able to project things better than if you're going to see a lot of volatility coming out of Washington.
You're right. Very well said. Kim, I got to ask you about something that happened this morning. The U.S. Treasury announced its refunding plan, the quarterly refunding plan. And the headline is it left its issuance plan largely unchanged for a second time. These statements used to be kind of a non-starter. It wasn't a big deal at all. Why has this become a potential risk or at least a source of contention or even drama at this point?
Well, I think we saw it start in October. In October, you saw rates really peaking, really just rising. And that was because of the way coupon issuance was going. And we saw a pivot. We saw them move to issuing, into the short end, into bills, and we saw rates drop. And they've continued to do that going forward. Now, this is a real traditional kind of thing going into an election. So I don't know why anybody's surprised. It's what every party does. So that's not a political statement. That's just what everyone does. But it's keeping things where they are. And again, that's another part of what we could see after November, right? We could see a new Treasury Secretary. We could not see a new Treasury Secretary. There's a lot of things that are going to happen at the end of the year that could really give the Fed new direction going into 25.
I have to ask you, as in your capacity as Managing Director of Fixed Income, we've seen years of rate hikes and higher for longer, and it has really changed investor expectations. The idea that they should and will get paid well just for sitting there, parking their money in the safest assets in the world, and they don't necessarily want to go out on the risk curve. Once we do get rate cuts, is it as simple to say that investors will put some of that money to work in the hopes of higher returns, or will there be resistance to that because of years of being comfortable just earning income?
Well, I think the thing with rate cuts is rate cuts are going to lower the short end of the curve, and it doesn't necessarily tell us what the overall shape of the yield curve will be. So if we see more issuance on the long end, if we see bond vigilantes get upset about the direction of the U.S. debt, if we see any of that, over the last week, we've actually seen the yield curve steepen a bit as the overall yield curve has gone down. We might see investors simply slide out a little further on the yield curve and just say, I'm happy going out a little further, getting, 4 to 5% in some, investment grade, 10-year type of piece and feeling comfortable with that.
All right, we'll see how it all shakes out. Kim, really appreciate your joining us today. Kim Friedricks is Managing Director of Fixed Income at Caden, Anderson and Rudnick. Thank you so much. Now, coming up on Bloomberg Markets, we discuss food inflation with James Beard winning restaurateur Caroline Styne. This is Bloomberg.
And that's all driven by price. And some of that has been close-in demand, but also it's just the balance of as we're taking in new bookings, which we get to see each and every day, the willingness for our guests to pay more for those experiences are very welcoming to them. They're willing to pay it, and they're also willing to book much further ahead.
That was the CEO of Royal Caribbean on our show last week, recently discussing consumers' willingness and ability to pay high prices for experiences. Now, its competitor Norwegian today said that it still sees strong pricing as the entire cruising industry sees continued demand. So with that in mind, let's turn now to another part of the hospitality industry, dining. Caroline Styne is a restaurateur and sommelier. She is co-founder of the Lucques Group and a founding member of the Independent Restaurant Coalition. Caroline, you just heard the CEO of Royal Caribbean talk about people's willingness to pay up for experiences, and certainly they're seeing that in their booking. What have you found as someone who's in the restaurant industry and people's willingness to pay for premium experiences?
Yeah, thank you for having me. It's a really interesting dichotomy because we actually operate the food and wine operations at the Hollywood Bowl. So I see people willing to pay for the experience of the ticket. Ticket prices have gone up so much and they are willing to pay for that. They show up for the show, but it's the additional that we're seeing that they're not willing to spend so much on. They're paying less for food. They're buying fewer items and fewer drinks at the actual theater and having them before they get there. And I see this actually in the restaurant business as a whole. We actually have been having a very hard time, especially with interest rates so high. They really affect people's ability to have that extra income to spend on dining. It's one of the first things that they will actually forego in order to save some money, because people's mortgages are higher, their debt is higher, they're taking home less money. And so we're seeing kind of a split on that.
So how is the food industry, how is the restaurant industry adapting to that?
It is really tough. I mean, especially here in Los Angeles, we're still suffering the results of the writer's strike and lower Hollywood production. So, we're seeing a lot of layoffs in our industry in Los Angeles. A lot of restaurants are really suffering because the public is not going out as much. They might be dining out 2 times a week instead of 5 times a week. And so a lot of us are really kind of tightening our belts. It's hard because with the price of food going up and our raw product going up, we are forced to be in this position where we really need to raise prices, but we're really battling against it because consumers are only so willing to pay more for food. So we're in a tough spot right now.
You're in a tough spot, but I mean, having said that, inflation and high rates have both eased a bit. I mean, the Fed has not raised rates for now 1 year, and we've seen inflation stabilize and even start to decline. So things should be different now at mid-year 2024 than they were perhaps at the start of 2024.
Yeah, I know. It's funny. You would think that we would feel that on our end, but we're not. Our costs have not gone down. Our labor costs have gone up dramatically. Minimum wage has gone up. Just in July, it went up. Insurance rates are going up. We feel so much pressure from all of the other aspects in addition to the raw product that it's still a real challenge for the restaurant industry, I have to say.
At the lower end of the restaurant industry, like McDonald's and its competitors, we know that they're offering those $5 value meals and just trying to provide as much value as possible to the consumer in this higher for longer rate environment. What kind of value propositions can sit-down restaurants who are under pressure offer consumers? Are they able to?
We try everything. We do happy hours where we offer, a lower price on certain items for a portion of the day. We just experienced Styne LA in Los Angeles, where it's a restaurant week, and we offer a discounted dining experience. And it's funny, we talked about experiences. This is sort of like that. It's a different menu for that. And that actually got a lot of good response. So, we enjoy doing those kinds of things where we can provide something different for guests to draw in new customers as well. And, we are trying to do special events and, lower pricing certain days, different kinds of things to attract people in where they can come in and spend a little less and still have that same experience. We're definitely trying to do that. But for us, it's hard. You can't really maintain a business on that because then our margins are lower. Yeah, but we're trying.
You talk about the lower margins, you talk about the layoffs. Clearly, there are cost-cutting efforts that restaurants have to take to survive and get through this environment right now. What parts of those cost cuts are visible to diners? What parts are invisible?
Oh, the visible might be that, we only have 3 servers on the floor instead of 4, that, we are, it could be anything from trying to find less expensive candles to use to the things that people may not notice quite so much. But for us, especially at our restaurants, we're really dedicated to organic produce and local farmers and products. And so we try very hard not to skimp on those areas. It's really hard to cut on those aspects. But wherever we can shave labor is a big one. That's kind of our biggest cost aside from food, which is hard because we want to keep people in their jobs too. We want to keep people getting their health insurance, et cetera. So it's definitely a challenge. We're trying everything.
Carolyn, really appreciate your joining us and giving us a snapshot of what it looks like in your world. Carolyn Styne is co-founder of the Lucques Group and a founding member of the Independent Restaurant Coalition. We're going to stick with this conversation in the hospitality industry because coming up, we hone in on the job market with Culinary Agents CEO Alice Cheng. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. It is Fed Day, and of course, a key part of the Fed's mandate is to maximize employment along with keeping inflation stable. So to that end, I want to welcome Alice Cheng. She is founder and CEO of Culinary Agents, a platform that helps workers find jobs in the hospitality industry. I think of it as a LinkedIn for the restaurant industry. Alice, thank you so much for coming in.
Thanks for having me.
So we're talking about inflation with Carolyn Styne and how higher prices are permeating every aspect of operating a restaurant. They're paying higher wages, the costs have gone up for food, and the overhead has gone up. What are you seeing on your end when it comes to hiring in the industry? Carolyn mentioned layoffs in LA, for instance.
Yeah, and I think it's also interesting is it depends on the city and the kind of micro environments. In general, we're seeing the cycles come back where ramping up for fall hiring is looking very, very strong for this year. In the past couple of years, it's been really focused on survival and recovery across the board. And we're seeing a little bit more focus on growth for restaurants. Yes, adjustments with potential closures, reconcepting, et cetera, but a lot of the other side as well with new concepts opening and new jobs being created.
So that's exciting to see this shift to growth from survival, as you put it. What do you think is driving that? Does it have to do with the fact that rates are likely to start falling soon? What's behind it?
I think everyone's hoping that rates are going to continue to fall soon. There's a couple of factors. I think one is I call it the pent-up excitement of new concepts opening, projects that were delayed in the past years, businesses focusing and structuring how they operate to prepare for growth. Demand. There's demand in different types of cuisines and concepts. Businesses connecting with their consumers differently as well as expansion into other cities, so kind of intercity.
How far along that process do you think we are, that shift into growth? Is it kind of the second inning of a 9-inning baseball game or like the 4th inning or the 8th inning?
I want to say we're seeing this is the beginning of the big push. A lot of 2024, as I mentioned, focused on growth, but still in that planning phase. Hospitality, especially independent restaurant, typically really look at the fall hiring season as their big push into the holiday season. So I think everyone enters it very hopeful and they prepare for the best. And then as things unravel, they adjust.
So I'm really intrigued by this fall hiring season and how it differs from, say, the summer hiring season when there are a lot of seasonal restaurants. I mean, you no longer are hiring high school and college students. Maybe you're companies are hiring people who are in it for the long term, right? Committed industry workers.
Absolutely. It's a different type of worker in some cases. I think what we've seen over the years with hospitality is that it's a profession, and the more tools and information are available to help both businesses and talent just look for a better fit and career pathing, the more exciting it is to stay in the profession. And so while you do have the I'll call it the flexible worker, folks who are needing a job for the interim or seasonal, there are far more professionals who are continuing to seek growth opportunities to work with great companies and stay in the industry.
So I want to that end, I want to bring in something that's obviously in the pop culture moment, which is The Bear, the Hulu series. It premiered in summer of 2022 and has, shown up every summer after that. It's part of the zeitgeist. It's turned high-end restaurants into a big thing. And, I hear people saying yes, chef to each other all the time. There's always all these memes on TikTok and everything. What kind of impact have you seen on your world? I mean, is there a lot of demand for Chicago restaurants, for instance?
Well, I think it has a couple of facets of impact, I think, on the industry as a whole since its inception. On Chicago specifically, of course, it kind of highlighted several specific concepts in Chicago. Chicago is such a vibrant, amazing dining scene in the current season, which I won't do any spoiler alerts.
Thank you.
There were a lot of additional cameos of industry folks, which was very exciting to see. I think why it's caught on so quickly and so aggressively is that it really dives into some real world examples of what people in the industry, workers in the industry, face. But at the same time, it connects it to kind of being human, right? They're facing real world challenges. And I think anything that brings in consumers and the diners into the world in a very exciting way, in a real way, is positive.
So one thing that intrigued me, of course, is that people know about wanting to be a chef or maybe a CDC like Sydney, but choosing front of house as kind of a profession like Richie, how do you see that showing up in your world? I mean, do you see people saying, yeah, I want to be in hospitality to be a host, for instance?
Yeah, it continues to show up. Actually, front of house positions, host, server, general manager, those tend to be the highest performing job ads on Culinary agents consistently. I think what we're seeing more and more is are these examples of how you can progress in the front of house, because sometimes it's a little less structured than back of house.
Okay, and you might even have to listen to some Taylor Swift along the way. Culinary Agents founder and CEO Alice Cheng, thank you so much for joining us.
Thank you, Scarlett.
This Fed Day. All right, we are looking at a equity market that is in the green right now. The S&P 500 up 1.6% at the moment on this Fed Day. Welcome to Bloomberg Markets. I'm Scarlett Fu. Let's get you check on where things stand in equity markets. You're looking at gains here for the S&P 500 up 1.6%. Broader market is higher, being driven by big tech and specifically chip makers. The Philadelphia Semiconductor Index up 5.5%. The Nasdaq 100 gaining 2.7%. Nvidia is the big mover on the day on an upgrade from Morgan Stanley, recommending that investors come in and buy the shares. Bitcoin, we're also seeing moving slightly higher, 0.5% is basically unchanged for an asset like Bitcoin, but lots of green on the screen here as the Fed gets ready to announce its decision in 90 minutes time, and Jay Powell takes the lectern in 2 hours. Yes, in 2 hours. All right, let's get you some midday movers on the equity side. We're starting with AMD, Advanced Micro Devices, another chip maker, up after announcing a higher than expected revenue forecast. AMD's new AI processors are boosting growth. Certainly that is showing up in the numbers. And this comes amid this broader rebound in tech as everyone awaits the Fed decision in a couple of hours. And Intel also higher. It announced plans to eliminate thousands of jobs to reduce costs and also fund an ambitious effort to rebound from its earnings slump. The CEO, Pat Gelsinger, is trying to build factories to manufacture semiconductors for other chip makers. All right, that is the picture here in equities. Let's broaden out a little bit and talk about how markets are moving typically in Fed days, especially around the summer. Jess Menton has written a story on this. And Jess, you talk about how you went through the data and you noticed that August and September are seasonally weak periods for the S&P 500, which of course makes it really interesting for this Fed day because the Fed is expected to start signaling that it could move on cutting rates.
That's right, because October is the one that typically has the bad reputation because you think of the stock market crash in 1989, you think of obviously the global financial crisis in 2008, but then we also, that month actually tends to be more of a bear killer. Like if you think of October of 2022, that's when we saw the low here in the S&P 500 since then, but it's actually September is historically the worst month. So if you use SEAG Go in the terminal, that's where you can look at the heat map for the seasonality data for the S&P 500. So typically over the last 30 years, you'd see the S&P 500 drop about 0.7%, and then August is the second worst month behind that, down about 0.5%. But the difference now is we don't always see those seasonality trends hold. A lot of times major indexes can buck those trends, but it's more of you have this moment where you do have obviously the Federal Reserve, and really it's what Powell signals at this press conference as far as when you see the rotational trade that we've seen, especially since that CPI report on July 11th, and the amount of flows that have gone into, especially sectors that benefit from rate cuts. If you're thinking about industrials, financials, REITs, healthcare, utilities, those are the ones that are seeing exactly. And of course, you can't forget small caps too that have really benefited from this.
So going back to this idea that the market tends to be weak seasonally in September and August, just the fact that people know that's there, it can also influence how they trade and how they position themselves. What's the reasons behind it? I mean, has anyone come up with actual fundamental reasons?
Well, there's some things that usually it's not really fundamental. I think there's a lot of things, especially if you look over the last few decades, that people like to point to as far as just basically volume being lower because not as many people are trading. And then obviously when you come back in September post Labor Day, when a lot of people, especially if they have kids and they're going back to school, there's different repositioning that happens there. But also if you're thinking about what could potentially happen, we might see something, especially if Powell does signal that rate cuts are on the way, you might still see something in this past few weeks where you see major indexes lower, like say with the NASDAQ 100, almost in a correction, dropped about 9% from that obviously July 10th high, but you could see still rotation into small caps. So if you look at right now, the Russell compared to the S&P 500 actually heading for its strongest monthly gains since February of 2000. And then you can also see something similar if you're looking at equal weight. So the SPW relative to the S&P 500 on track for its best month since April 2009. So you might still see that movement in those particular groups, but then still the major indexes pull back if you're seeing, because they're weighted more heavily, obviously, toward those growth stocks.
The extra wrinkle for this year, of course, is an election year as well. So how does that influence what we tend to see seasonally for the S&P and the NASDAQ?
So usually what happens is the first half of the year in presidential election years tends to be weak, and then the second half is stronger, more toward the last 2 months, because then there's more indication of who's elected and also whether or not there's gridlock in Congress, because that's something that traders also care a lot about, because obviously you wouldn't have major swings in policy changes depending on that, but because actually there was a 14% gain the first half of this year, and that was the second best since 1928 based on some Ned Davis research. So because of that, it's a little bit more tricky going into how this could play out in the next couple of months, because again, it was front-loaded with the gains this year in the S&P 500.
All right, good stuff. Jess Menton, thank you so much. And of course, you can read Jess Menton's story on Bloomberg.com on what typically tends to happen to the S&P 500 in these summer months, and of course, with the added wrinkle that it is a Fed day, and we have an election coming up. All right, let's continue the conversation, especially when it comes to what we're anticipating for the economy and with the Federal Reserve. I'm pleased to welcome Nationwide Insurance Chief Economist Kathy Bostjancic right now. Kathy, good to speak with you. Are you comfortable with what the market is pricing in right now, which is no change today and a potential soft signaling towards a rate cut in September, maybe 2 in 2024?
Hey, Scarlett, happy to be with you. Well, certainly, no rate cut today seems, very likely. There's been no signaling from the Fed that they're prepared, and it would look like they were panicking if they cut rates today. But it's all about the signaling that we get from the policy statement and the press conference as to, how clear do they want to, kind of give a heads up that September is likely. And I think, after that, our view is that they do cut rates 25 basis points in September. Then, November and December are live meetings, even though the FOMC meeting is just days after the election. In terms of what the market's pricing in, I think it's reasonable. I mean, our base case is for 50 basis points, but I think it's certainly reasonable that they could go, 75 basis points by the end of the year. Depends on the data.
It depends on the data, and of course, we get a big data point on Friday when the jobs report for the month of July comes out. And of course, there's been a lot of talk about the job market cooling overall, and you see that in some of the data points, but you don't necessarily see that in job growth. For instance, we are expecting, according to economists surveyed by Bloomberg, 175,000 jobs added in the month of July after 206,000 jobs added in the month of June. That doesn't necessarily signal a cooling labor market, again, even as perhaps the unemployment rate rising does. What kind of nod do you expect Powell and the Fed to give to what we're seeing in the labor market, which is clearly turning, but still kind of in the process of it?
Yeah, those are great points. I think what we're seeing is a moderation in the labor market. And what Powell has recently said is that's a welcomed moderation. It means that we're no longer have, an overheating condition. And it's still strong. Now, time will tell whether this pivot towards moderation is a harbinger of something rockier, like a harder landing, or indeed is in line with a soft landing that the Federal Reserve would desire. So you are seeing various measures, right? The duration of people unemployed 27 weeks or more, that's ticked up. As you said, Scarlett, the unemployment rates moved up, but all of them are still really low, not signaling, a collapse in labor market. And it's probably, it's going to take time to see how this moderation really plays out.
Yeah, it's going to take time. And of course, in the meantime, we're keeping an eye on consumer spending. And I'm curious to get your take on what you are hearing from the companies that are reporting results when it comes to consumers' willingness to pay. We just spoke with a restaurateur who is saying that people are willing to pay for experiences, but they're cutting back in other ways. For instance, they're going to the Hollywood Bowl, buying tickets, but they're not spending for food and drinks because, they've already paid what they feel comfortable with, and they're going to hold back in other ways.
Yeah, no, definitely. Consumers are tightening the belt a bit, becoming more cautious, maybe a bit more frugal. And you're seeing that with the earnings data, reports overall. Corporate earnings have been good, but if they're consumer facing or sensitive, there's where you've seen some comments about, the consumers being, again, more cautious. So it makes sense. The pandemic savings are been run down, labor markets moderating. And also we're seeing a lot of the lower income and younger people have really maxed out on their credit cards. Those have been the tailwinds for the consumer. So again, for the consumer, moderation right now, time will tell whether it's a harder landing. I think, the risks are still there, but also a pretty good chance we could get a soft landing here.
How are you thinking about the election? I mean, we've had an awful lot of big headlines in the past month, and there's this sense of excitement now about November that has kind of replaced this feeling of deja vu, as in, the same two guys who were running 4 years ago are running once again. Do you think that will make its way through the economy in terms of spending, in terms of confidence?
Well, you may see some lift in the consumer sentiment readings. They've been really low. They've been out of sync, right, with overall consumer spending. Yeah. So we don't put a huge weight on that, but it's possible. I think the fundamentals are going to really call the tune here for the consumer, and income is going to be consumption is going to be more in line with income now. Before that wasn't the case. Consumers could rely on the pent-up savings that they had or use credit cards. That's more difficult now. So I think in terms of the election, we're going to really have to wait and see, what the outcome is and what legislation is actually passed for us to really kind of judge the impact on the economy. But certainly things are interesting, no doubt about that.
No, and they'll continue to be interesting as well. Kathy, we started with the Fed and Jay Powell. Let's end with the Fed and Jay Powell. What are you looking to hear from Jay Powell? What would get your attention this afternoon from Jay Powell?
Yeah, I don't think he's going to be explicit in signaling September, because it really does raise the question, well, why not go ahead and cut rates today? So I don't think they'll be so explicit, but I do think the door will open wider. So look, first we'll examine the policy statement. How do they characterize inflation, the balanced risk between employment and inflation? And then his opening statement in the press conference and the Q&A. So really the press conference, I think that's where we'll get the most information and probably like the forward guidance that the markets are eager to see. But I think he's going to open the door but without really endorsing, hey, rate cut is coming in September, because there's more data for them to evaluate.
Yeah, opening the door but not stepping through it. Kathy, really appreciate your joining us. Kathy Bostjancic is Nationwide Insurance's chief economist. Coming up on Bloomberg Markets, we're going to focus on Meta's earnings. The stock currently up more than 2% as Wall Street gets more skeptical of AI spending following disappointing numbers from Microsoft and Google. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. It's time now for Stock of the Hour, and we're focusing on Meta. Higher in the session right now, and of course, it'll be releasing earnings after the U.S. closing bell. Investors are really hoping Mark Zuckerberg and company can do a better job than Microsoft and Alphabet in convincing Wall Street that lofty spending on artificial intelligence is worth it. So let's get right to Bloomberg Intelligence senior analyst Mandeep Singh. That idea that spending on AI is worth it is going to be encapsulated in the Capex number. And right now, the Capex number everyone's looking at is about $9.5 billion. That's up substantially from last year, right?
Mm-hmm. And look, I think they are going to come out and probably raise it by 20 to 30% if Microsoft is any guide, what they did last night. And in the case of Meta, I think the story has looked really good in the past 12 months because, there have been cost cuttings, revenue has been accelerating, they initiated a dividend. Well, I think they're going to run into some tougher comps, and Street will want to know how do they monetize all this GPU capacity they have, whether it's in the form of AI assistants that go on their AR glasses, or is it some other form of monetization? Because they clearly don't have that cloud channel, which all the hyperscalers have in terms of showing the AI monetization.
Right, exactly. You point to something like Microsoft, where Satya Nadella talked about AI contributing 7 points in the first quarter and then 8 points in the second quarter to overall growth. But not being more specific than that, how much specificity can we expect Mark Zuckerberg to really offer when it comes to the payoff from AI spending?
Yeah, I mean, look, they are in a great position because they have their own large language model. Think about, Microsoft relying on OpenAI, Google has Gemini. Meta has its own large language model, which is a great position to be in. The problem is they've open sourced it, and they don't really charge any licensing fee for their model.
For now.
For now. And so that begs the question, again, if you're ramping up your CapEx, you're increasing it by another 10 billion, where is the payout? And some of that payout will get reflected in the engagement trends on Instagram, on WhatsApp. Ad pricing gets better. So there are all these embedded metrics in their business, which should look good. But then Street is focused on the exclusive Gen AI contribution. I mean, that's what I think everyone feels good about. So it'll be interesting to see if they find a way to quantify that.
The Street is saying, show me the money. I want to see the money. Show me the money. Yeah. You mentioned the efficiency, the cost cuts and everything. If we back up a little bit here and think about what's been happening to Meta over the last couple of years. In 2022, it doubled down on the metaverse, and that did not play out as Mark Zuckerberg had hoped. So 2023 was a year of efficiency, big cost cuts. 2024, the return of cash through $50 billion buybacks, the start of a new dividend. Does he need to continue to wow investors on the financial side, continue to give them treats to keep the stock, elevated?
I think so, and that's where the capital allocation has gotten better. I mean, clearly, once you initiate a dividend, you're not going to take it away. And buybacks, I think they will continue on that path. Still, the top line matters. And that's where I think everyone wants to see whether they can continue to grow top line at over 20%, or will that moderate to low teens? And I think we'll get the answer tonight.
All right, let's talk about the other big tech earnings that are coming out later on this week. Alphabet, sorry, not Alphabet, Amazon. Too many A names. Amazon coming out with the earnings, and AWS is going to be a big read on AI spending as well. Based on what we learned from Microsoft and Alphabet, do you expect Amazon to come out with anything different?
Yeah, so in the case of Microsoft, we saw some sort of substitution, with people spending more on AI, but actually taking off spending on the non-traditional, the traditional cloud revenue. And so that's where Amazon is the biggest player when it comes to the traditional cloud compute. If that's softer, that should hurt Amazon in a bigger way. Now, we'll see if there is that substitution effect, but I do expect positive news on the Amazon ad side. I mean, that's one business that's been humming really fast, 25% plus growth at a $50 billion run rate. And that, I think, is hurting the likes of Pinterest and the smaller digital ad guys. So it'll be interesting to see if that continues to outperform.
And that has less to do with AI. That's just Amazon executing well.
Just executing very well on the e-commerce side. It's like slotting fees that everyone has to pay to, operate on Amazon.
All right, Apple. Apple, of course, with its AI-enabled phone, hasn't come out yet, but that's the excitement. So it's all in the forecast then, isn't it?
Well, and they've delayed their rollout of Apple Intelligence. Again, you have to find that AI connection. In the case of Apple, they did announce Apple Intelligence, but they said the software side of it will be delayed by a few months. So it'll be interesting to see how that impacts that refresh cycle that everyone is excited about.
Yeah, the big refresh cycle that people are counting on right now. Mandeep, always a pleasure. Thank you so much. Mandeep Singh is Bloomberg Intelligence Senior Analyst. And of course, he will be back on Bloomberg Markets later on when Meta does report its results. Coming up, BlackRock leading the charge to offer access to private markets through ETFs, but not without some challenges. We've got all the details next. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. Now, Bloomberg News is reporting that some of Wall Street's biggest firms like BlackRock, Invesco, and Apollo are signaling that they want to offer access to private markets. We're talking private equity, private credit, through ETFs. Samara Cohen, BlackRock's CIO of ETF and index investments, spoke this week on ETF IQ about this possibility.
We've given a lot of thought to what is the extension of our ETF and indexing capabilities that we've built into private markets. Again, going back to this theme, and it's going to be a constant theme, particularly given the correlation of, traditional risk assets in the last couple of years, or what are the portfolio diversifiers? And private markets are increasingly going to be viewed as an important portfolio diversifier. So how we actually make private markets accessible through ETFs and index is incredibly interesting.
For more on this, I'm joined now by Bloomberg News cross-asset reporter Vildana Hajrik, who co-wrote the story. And Vildana, Samara makes clear that they've been talking about this, but talking about it and actually doing anything on it are two separate things. How close or far away are some of these firms in actually putting private assets into ETFs?
That's a really good question, and they say that they're working on it, and we do have some of the biggest names. We have BlackRock, Goldman, Invesco, all saying that they want to be part of this boom because the private asset market is a $13 trillion space.
Yeah,
and currently, the argument goes that retail investors don't really have access to it. So if you think about pre-public companies that haven't gone public yet, something like Uber had grown tremendously before it went public. Something like that isn't available to retail investors, and so these firms are trying to work on it. It's really, really difficult. For regulatory reasons, for technical reasons, ETFs are super liquid.
Yeah.
Private assets are very illiquid by nature. Everybody knows this about the private asset space, and so they're trying to figure out ways, potentially, to do it. I don't think a total pure play is possible because the SEC does set some limits on how much of a fund can actually be, how much of it can be in.
So that's interesting that the SEC sets some limits. What does it currently allow? And I mean, that kind of would prohibit the possibility of, private assets in an ETF wrapper.
Exactly. So it's a 15% limit. We do already have ETFs that track indices that track, the IPO market, for example, or SPACs, but nothing that is an actual pure play yet.
So this would all be synthetic exposure, in other words.
Yeah.
There are some ETFs, though, that do provide some private market exposure. What kind of demand do they see? I mean, are these actively traded products?
For the ETF space, it really varies. There's a really popular Invesco product actually that does tend to see some inflows. It depends on the trends, I guess, because if you think back to the pandemic, a lot of people were into IPOs and SPACs, and you can consider those as being part of this space. It really just depends on what the ETF is, what it offers.
So in terms of time frame, we're really thinking months or years, not weeks here.
I don't think it's weeks, no. But we do have all of them actively talking about their interest in trying to make this happen. But how far away they are from it, I don't think any of them would actually admit to us.
Yeah.
They're really far off from it. So we'll just have to very closely watch this space because it is super interesting.
All right, and of course, you will keep us up to date on all of this. Vildana, thank you so much. Vildana Heinrich of Bloomberg News, cross-asset reporter on how private assets in ETFs is definitely something the big firms are thinking about and working on. You can join me alongside Katie Greifeld and Eric Bostjancic, by the way, to hear more about the whole ETF industry every Monday on ETF IQ at noon New York time. That does it for Bloomberg Markets. This is Bloomberg.